Welcome to the CPACE Confidential, where you'll hear about the hottest happenings in the world of CPACE, commercial real estate, and beyond. We speak with the top players doing the most exciting projects and discover just how CPACE has evolved into one of the most innovative financing options in the industry and how you can use CPACE to be more successful in your business today. Now here's your host, the CPACE guy, Adam Lipkin.
Hey, everybody. Thank you so much for joining us today on episode 2 of the CPACE Confidential. Really appreciate all the great feedback. Just launched the show last week, and I really enjoy hearing all the comments, just trying to continue to improve it and be able to continue to add as much value as we possibly can to those of you tuning in. So in that regard, really excited, gonna jump right into things with our guest, and really happy to have him on the line. We've done quite a bit over the years, really in the trenches, getting a lot of really exciting things done together. But I want to start out with a question today for you. And in that regard, I want to know from you specifically, what leads to best execution? What leads to best execution when it comes to financing your commercial real estate deals? Leave us your answer. We're going to ideally get it live at the end of the show. Just want to hear how you put things together. And also want to be able to make sure we get everything answered, any questions you guys have. So if you're tuning in live and you do have a question, make sure to also put it in the comment section. Well, you'll have a chance to be able to get it featured at the end of the show. We'll try to answer everything that we can. So appreciate that as well. All right, with no further ado, I'm going to bring on a good friend of mine, a guy that we do a lot of really exciting things with. I want to bring on Brent Connell, Brent with Geneva Capital.
Hey Adam, how are you doing? It's really a pleasure to be on the show with you.
Yeah, I'm so excited to have you on, man. This is going to be a real fun conversation. I feel like we're talking multiple times a day or a week, so lot to discuss, lot to share about, and always such a pleasure to be able to have a conversation. So let's just get into a little bit of background. Love for you to just share a little bit about Brent Connell, a little bit about your background in commercial real estate and Geneva Capital, and what the focus is.
Yeah, so I'm at Geneva Capital, obviously, as you said, when we're out of Chicago, and then we also have another office in Indianapolis. And I've been at Geneva Capital almost 4 years. And there are a couple of things that we do. And a big thing that we do is that we've got a bank syndication program where we are heavy in construction lending from the $5 to $50 million range. And we've got a grouping of about 40 community banks in Illinois, Indiana, and Wisconsin, where we will write the paper in our name, we will service the loans, and we'll manage the construction draws. We think that we bring a lot of expertise to the community banks since we've been doing this for 31 years. And since, a lot of the community banks have, with the increased regulations, they just don't have the expertise to properly execute construction lending. And sometimes it's a real painful process. So we're able to bring bigger and higher quality projects to the community banks that normally would not have the legal lending capability to do that. And then with that, the loans that we're doing, those are traditional bank loans. So they're in a tight lending box. So there are lots of loans that don't quite fit into that box. They fall out of bed. Or once you get above 50 million, it's you're herding too many cats, so it's difficult to get a consensus on approvals or any modifications. So once we get above that size, we will migrate into private deals that we're doing a lot of note-on-note lending, and then also we're doing some lending that will include some CPACE or some SSA bonds or some ground leases.
Yeah, including
some mezz lending or pref equity layered on top of the transaction. So I think, as construction costs have gone up, and by and large, the banks have not gotten hog wild in their advances, it's really created a need to provide creative lending, and creative lending not by, things that don't make any sense, by prudent creative lending, while adding to the capital stack with different transactions that work out for all parties. And that's one thing that we've worked on doing, and we've had some success in that lending arena. And a fair amount of those deals I can attribute to Adam. He's helped us on it, and a great thing that Adam and I have is I believe we've got a common philosophy, is that, we're not afraid to discuss deals back and forth with each other, and, say, well, what do you think about this deal? And sometimes we'll come up with ideas that Adam would not be a part of, but I think it's great that we can have an open and honest dialogue where I don't feel that Adam will hold back on providing the input on what he feels is the best execution on a transaction, and I do the same with him, I believe.
Yeah, for sure.
No, I think it's been a great relationship.
It's been awesome. I definitely want to get into that. Just it just creates so much more possibility when you could have that trust, and sometimes you got to just say, I'm going to give it, before I expect it. But it's been awesome. We'll talk a little bit more about what that led to. But let's just back up a little bit more about the background, because I found it so fascinating when I learned about what you're doing with Geneva. It's such a need, because to your point, so oftentimes banks are limited with what they're able to do within their box. And it's like, what happens to like 90% of the deals that they're looking at, right? So it's kind of like, I saw that happen firsthand. I was at a shop where it was part of a larger regional bank, and I was like, what are you guys doing with all the deals that you're that you're saying no to? It's like, let me take them out to market, let me place them, And so I when I first found out about your model, I said that just makes a lot of sense. You got all these great banks that have just lots of people coming in, lots of good customers, and they want to be able to provide best execution. They want to be able to serve them. And what better than to have just a really strategic relationship with you and Wayne and Geneva to be able to say, hey, this might not be a fit directly for the bank, but by the way, we have partners that might be able to help you for this specific need. So I think it's awesome. Tell me a little bit though. I think I heard the story, and I thought it was just really interesting how a lot of times innovation comes from adversity. How did the syndication platform get set up 30 years ago?
Well, it came about from the principal owner of Geneva Capital, Wayne Massey. He was lending. He was doing a lot of leasing in the 90s when the late 80s, when that was a big program then, and he was coincidentally doing a lot of leasing for if you're flying over the middle of America and you look outside your plane, you may see a lot of green circles, and that's agriculture that's being grown, and that circle is a irrigation system that basically goes around the circle at segmented times. I don't know, once every 3 days or whatever. I don't know. I know enough to be dangerous about agriculture, but those irrigation systems are, depending on the size of the acreage, or could be several $1 million. So the company that he worked for was manufacturing that equipment, and they had a need to lease that equipment. So they would lease it, and then they would sell the paper to a bunch of community banks. And then, when the tax laws changed and made it not as productive for the banks to do the leasing programs, he had a bunch of banks that had the need for paper, and he moved back into what he originally started his understanding with when he got into the banking world, was real estate lending. Yeah. So that was kind of how he morphed into the program that he has now. And
it's interesting too. Like when I think about the philosophy with that and being able to do more together, I think it just really is a great catalyst to get right into our relationship and how it started. I think we got connected a few years ago. I want to say it was at the Crittenden conference, if I'm not mistaken.
It was. Yep.
It's always like a good time at Crittenden. It was fun to go to the one recently. I'll tell you, I had no idea what the turnout was going to be. I was like, it's either going to be just absolutely crazy packed because people haven't been to a conference in 18 months, or it was going to be a little light. It was a little light, but it was still awesome to see.
Yeah, I think it was about 50% capacity. That was my guess on it.
Yeah,
but there were a lot of quality guys there that were decision makers. So
So much agree with
a
that.
great-
Yeah, I mean, just really good quality guys. A lot of people we knew, a lot of good people that we are now starting to do more and more with. So it was really cool. It's always at a good venue. But I think we met back a few years ago. I just gotten into the CPACE world. I don't know if you were familiar though, but tell me, what was your first impression when this guy's like hawking you about this, CPACE? Did you know about it? Were you kind of like, what is this
I knew
thing?
nothing about it. I'd heard about from some other program that somebody was considered the new hottest thing that could get done.
Right.
And then all of a sudden, from our experience in the community banking industry and the lending there, it was like, well, how can that fit into the program that we have? It probably is more conducive to the private lending arena, and maybe at a later date, it'll be adopted by, the community banks as, they're more just like it took them a long time to get comfortable with ground lease.
Yeah. Yeah, for sure.
Or I'm assuming, because ground lease has been going on forever. I'm not that old. I'm getting older.
Look, it's just sometimes, what you're familiar with, you're more comfortable doing. So, I mean, people have, ground leases have been around for 1,000+ years now in a new structure that makes it more user friendly. But, with CPACE, it's kind of one of those things that was bifurcated in how it got rolled out. You actually found a number of the community banks doing it when it came to stabilized real estate and borrowers that wanted to say, hey, I want to, do new HVAC or do new lighting. And you could kind of say, oh, I'm going to finance these types of improvements because it led to energy savings. What we're focused on and what you and I have had some fun with is really using it for what I think is the bigger area, the bigger pop that's growing now over the last several years and leading to much larger transaction sizes. But using CPACE with construction projects where there's oftentimes no income and you typically have to couple it with the other pieces of the capital stack, most notably the construction lenders. And so let's kind of talk about, so we connected up, started looking at deals together. So what did you initially like about CPACE? What did you find interesting about it? What intrigued you?
Well, what intrigued me about that is it was, similar to, a special assessment on the tax rolls. And the funds were being used specifically for, for some energy efficiency improvements. So there was a limited lifespan for the funding dollars, and albeit it is a priority lien on the project, there is some limited clawback as far as if there's a default in it. It's not a default to the borrower, it's a default on the property.
Yep.
But there's lengthy, you've got more lengthy cure times than you would have in a traditional loan or a ground situation. So there's some attractiveness to that. And it takes, people, preaching the gospel about, the merits of CPACE.
Yeah. I mean, I also just found at a most basic level, it's interesting. I mean, I remember the guy that ran the shop that I was just at, one of the things that hooked me is he was like, you're basically going to be the Dos Equis guy of real estate. And I was like, I'm going to run with that. But it was really fun for me to show up with something that was unique. I found that was a really cool thing because oftentimes, to what we were talking about before, there's a certain philosophy that we have when we connect with people, we have a chance to add value. But if someone's not willing to give you initial attention, it's tough to add that value. So I found that CPACE was also just something very unique that you could begin a conversation with. And there's oftentimes where, and even with us, we've had conversations where we just were like, it's just not going to be a fit here. Like, this is just going to be too much of an uphill battle. There's too many people that need to get comfortable with this that maybe don't know what this is. And we might just say, we got to pivot to another solution. So I found that what was so intriguing about it was just interesting and it was innovative. And it just led to typically connecting with people that resonated with looking for innovative solutions. So I like that a lot. And I thought, think about it. Had we not had something intriguing to talk about, you might have just been like, what's this guy going to do different than the other 20, 30 guys I'm going to meet at a conference? It's like, I know about all these other, traditional lending products, but, I've heard about this, or I maybe didn't know much about it. Let me find out more. And so I like that it creates opportunities to create, more connection with interesting conversations. So
it's also important, I think to, once you've assembled, some lenders and some CPACE groups, to try to, if you can, stick with those groups a little bit more because of the, you do have some complexities and some nuances in the intercredit agreements, and you know how attorneys are. It doesn't take long to run up a big attorney bill for that. So you don't want to be reinventing the wheel all the time and having complexities in the execution.
Yeah, I agree. I think sometimes you having like a good core group for specific needs, and CPACE is certainly one of them that you feel you could trust, you could rely on, get honest information is huge. It's everything. So there's a lot of sugarcoating in the industry, and certainly with CPACE, a lot of overpromising, under delivering. So it's important to have somebody that's going to tell you, what's real, what's not BS, and hey, here's what you might be able to do. Here's what's happened. We could push the envelope, but I always try to subscribe to that philosophy of being like more of like a let's be real with what's actually happening, and let's still be optimistic about what we could do, but let's not pretend that we're somewhere where we're not. So, anyways,
there are problems too on the borrower side too. We had a situation where perfect retrofit for a CPACE transaction. We went all the way down the path, and the borrower told me that they had the senior lender was all on board with that. And then all of a sudden, at the end of the day, the senior lender wouldn't sign off on the transaction.
I mean, let's talk about that as like such like an important thing. I mean, it is like one of those delicate balances of being able to make sure you get the important questions answered, but also trying to like really drill in like, hey, this is really going to come up. So we want to make sure that this is something that's been addressed. So I've seen that a lot. You saw that.
Oh, no, I got that covered. I got it covered. And all of a sudden, well, they said they would, but now they're not.
All right, let's cover this for just a couple of minutes. When you are working on a deal and somebody is mentioning CPACE or you're introducing it, one of the biggest things is you need to make sure that the lender, if there's a current lender in the transaction, has done a CPACE deal or they're comfortable with it. And not just they're comfortable with it, but at the specific dollar amount that you have in mind. I would say go so far as to get it in an actual term sheet where that CPACE is front and center, and it's not just some verbal with somebody at like a bank or non-bank that's saying, "Oh yeah, we're good with this." Later, you find out that maybe somebody has no clue about CPACE at the credit level. So
and that's where I came into. They hadn't, they hadn't seen a copy of the actual loan or the intercreditor document they're going to sign off on. They're like, "Whoa, wait a second, this one."
Man, I've seen that so many times, right? It's like you got these big organizations and you got like maybe somebody in business development has a great relationship with like a client. And it's like, sure, we could do this, thing. If other banks are doing it, whatever. And the next thing you know, just nobody's even looked at it. Or if they did it, it was under the most unique circumstances. I think it's talk about an insight to be able to not have to go through just a lot of pain, get that flushed out early on. So I'm curious, had you done that over again, what would you do if that came up and somebody was like, "Oh yeah, I got it covered"? Would you dive deeper and say, you got anything in writing?
Yeah. I would say, I think it would be advisable that for us to, sometimes, obviously you're walking a delicate balance when you're wearing for that element. I was wearing my broker hat, but it's like, hey, I think, why don't we have a conversation with your senior lender on it, and let me be involved in that, so we're all on the same page, so there's no misunderstandings, and we can have a simplified and an expedited execution. So I mean, to put it in the right terms.
It's like one of those conversations, like, you never have a good time bringing up, but it's like, listen, there's some lenders that might be challenged if there's ever been a felony created by anybody in the borrowed entity, but you need to get that flushed out sooner than later, because if that comes up down the road, you're probably just, like a really tough position. So I think that, being delicate in how you introduce things is huge. What I've erred on the side of is try to get it in a proposal. If there is in fact a lender, I always say, let's see if you have some kind of documentation that shows, at what level. And if not, even if there was a verbal that somebody said they allowed a certain amount, it's important to say an amount, not that just they're open to it, because it shows if there's a specific amount that's been considered, clearly it's been reviewed internally. Lenders are sizing this to a certain acceptable coverage. Usually, they're looking at it as long as it's still above their minimum debt service coverage ratio. Even if they look at it as like, unfortunately what happens a lot, like an operating expense, at least you could still cover because you're financing energy savings. And so at least somebody would have done that kind of, iteration and underwriting. But this is specifically for existing stabilized properties where you have a seasoned loan and you want to just flush out, has the lender confirmed it and, allowed it? If it's a new construction, let's talk a couple of those scenarios, because we've been involved with some really exciting projects where, it was oftentimes a client of yours, we're going out in the market, you were looking at a variety of ways to execute on, pretty large financing requests, and CPACE became a consideration that got into the equation. And so let's maybe pivot to using CPACE with construction. And maybe there's like a project or two that you could think about that over the last year or two that we looked at. I'm thinking of a few of them, but where that entered the conversation, either the bar brought it up or you brought it up, and then maybe just talk a little bit about it, to kind of like how that came about and maybe some of the experiences with a particular project. If you could think of one, we could talk about that.
Yeah, I know there was a Midwest hospitality transaction that we're both involved in, that took a long time to evolve and a long time working to, we had a feeling that would probably be the best execution on that transaction. And that took several iterations with a couple of different lenders that we went down the path a little bit with, but it was $100 million project. So it was a large project, and it had, what did that have? 24 million in pace?
Yeah, about 22.
Yeah. And
I think it was one of the larger ones that have gotten done to date. So
yeah, so we finally got the we got the right lending team in place, and well, then we had other iterations with the municipality that extended the time frame a few months on that one as well. But it took a lot of diligence on all parties, but it turned out to be a real good execution for the borrower. And the borrower was very happy.
What had you think early on that, oh, this might be a fit for CPACE? Was there something in particular? Was it, hey, this is going to be a complicated deal, this is going to be something that there's going to be a need for more of a private lender? Or it
was a complicated deal where it needed to be a little bit of a private lender, and the amount of the complexity of it being a vertical subdivision, that added to the complexity of it, and the lien release that was needed for the specific number of floors in that vertical subdivision. So it was stretching the capital stack.
Yeah. Yeah. What do you think ultimately led to that getting actually executed? I have a couple thoughts on it, but I'm curious, like, what do you think led to it getting done the way it was getting done?
I think it was just perseverance on all parties.
Yeah. Yeah. I think for sure, and it definitely took some time. I also think that there's something to be said about, going back to what we were saying before, is having an option. I think if I remember correctly, there was a backup option, which the thought was, hey, we're going to go this route if we don't get what we want from what ideally was going to be the primary choice, which ended up working out. But I do find when it comes to somebody like yourself, if you're running a process, you're going to market, there's infinitely better of a chance in getting CPACE or ground leases or any of these structures involved when you have a little bit more of a competitive bid, ideally 2, if not 3 lenders that really want to do business with the sponsor, like the business plan. And you could really kind of use that as a way to be able to, let CPACE be something that could become part of it to make it a little bit more advantageous. So you're trying to imply that lenders may have a little bit of a lemming mentality? Of course not. Who would do that? So I think that was an interesting. I mean, that was an unbelievable execution. That was incredible. But I think it's almost like a poker game. If you didn't have the leverage to say, "Listen, we're going to go in at the
absolutely.
So poker." Let's talk about some of the recent opportunities. I mean, we've been involved in some amazing things this year. You've had a tremendous year. Some really cool projects that you've been involved with.
Let's keep it rolling.
That's knock on wood, man. I'm with you on that. Let's keep it going. Let's talk about some recent success stories. And let's see, look, we're still in this COVID environment. It kind of shut down a lot of hotel financing in large part. I know we've been really doing quite a bit on the residential side, a lot of multifamily. But let's talk about what's happening right now in multifamily construction. I've seen a few things over and over again where you have, an experienced borrower that might have a great site that they've now gotten entitled, ready to go. But they might be doing a project that's a little bit larger than what they've done historically. And you'll get involved with those deals. And, you have to look at it from really creative lenses. So tell me
especially with the cost creep that's come on, that's adding, significant dollars to the amount of the construction costs on a transaction.
Yeah.
A transaction that I recently completed this summer was not a CPACE, but it was actually an SSA bond And if you don't know what an SSA bond, it's a special assessment bond. And instead of acting as a CPACE, which goes toward energy efficiency, the SSA bond is generally toward the infrastructure on a project for the sewer systems and the road systems internally that are in the project. And it was used very heavily in the early 2000s in Metro Chicago for big single family subdivisions when there was going to be 600 lots, and they're expecting it was going to take a long time to sell out the project. So they had a $20 million special assessment bond that was paid out over 20 years. That was a more efficient way to fund the project, except for when things blew up in 2008 and you had these lots for sale and they're subject to, an extra $2,000 a month SSA assessment. It really turned the lots value to zero quickly when there were other options that didn't have the SSA lots available. Sure. But that's turned around as it happened.
Yeah.
But that was a transaction that we completed that we were able to get a 90% leverage on the capital stack with the senior lender and the SSA bond. The SSA bond was probably about 13% of the capital stack. So that turned into a real good execution.
So let's talk a little bit more about it, because I think it's such a creative execution, very creative, and it was recent. So this was like $70-80 million project.
It was $65 million project. Sorry.
So large ground up multifamily, right?
Yep.
Ground up multifamily, $65 million project.
Garden style apartments. They're it was 4-story with a few townhouses.
Yeah. So what comes up, right? So maybe you could talk a little bit about, a lot of times clients, there's, maybe a historical approach where it's maybe, and this might be a better fit for your bank syndication side, where you guys are looking at it, clients may be doing 60-65% leverage with like a traditional bank. They're putting in the equity. Maybe a project is anywhere from 10, 20, 30 million. And that works. Maybe they've done 1, 2, 3, 5 deals. And then they, come into a much larger project. And in the case, where they have now a great site, familiar with the market, now it's double, triple the size. And oftentimes banks get tapped out either due to size or due to just exposure to a client.
Well, then plus also this was a well-established sponsor developer in the area, but they'd taken their lumps in in 2008, like a lot of people had, and they're clawing their way back. So they weren't in a position to provide, traditionally the banks want a borrower that's got 10 to 15% liquidity of the loan amount and net worth equal to the loan amount.
Yep.
So when you're getting into a $65 million project, you got to be a good sized player, or have saved a lot of money over the years and not taking your lumps on some deals to be able to qualify for that. So this sponsor was not in a position to qualify for a traditional bank loan. So we had to look at other creative financing on it. So that's kind of how we led the path on this. And this is a unfortunately, a lot of transactions that I work on have a long lead time. This, was probably approaching 3 years of gestation period between original conversations and closing. So, fortunately, I've got enough deals in the pipeline that I can put food on the table in between the paydays.
Yeah, for sure. It's interesting. It's like, sometimes you kind of have a sense of how it's going to play out, given that, you've been in the market on a number of occasions and you kind of are like, hey, it's probably going to go this direction. I think in a lot of these situations, a lot of folks, there's a concern about when the project's larger than what they've typically done. And there's very likely going to be a need to bring in like a partner, some kind of co-GP that's going to be able to get lenders more comfortable and just be able to ultimately execute on a much larger financing. It's like you almost are very sure it's going to go that direction, but it's like you almost have to have the borrower get to that conclusion. You almost have to make a market, best efforts, go out there, get that feedback. But it is interesting to see how it
absolutely you've got to do that, because a lot of these projects, the sponsors put their blood and guts into the transaction. And it's their baby, and there's like, who the hell are you to tell me that I've got to give up a percentage of my project when I can do this all myself?
Yep. Yeah. Comes up.
So
I feel like that's
it's
like
a
a
delicate
consistent thing.
balance working them through that process to get to the destination that you have an idea that probably needs to happen,
Yeah.
early in the process.
And I think it's interesting too that you could actually have both. You could have a partner and still get very high leverage where you could still retain quite a bit of the promote and the upside
Yep.
and do it all. And so I think, so it was very interesting. Let's talk a little bit about this. So you mentioned it was a $65 million project and you got 90% leverage. That's incredible in this market. I mean, even though multifamily has been like the hot product type, you're still finding that by and large, private lenders, probably more like in a 75 to 80% level. They kind of are all looking at it under similar lenses. And so to now go past 80% into that 85 or 90, very challenging. Obviously, everybody wants as much money as it could get for as little cost as possible with as much flexibility.
Yeah.
Usually you have to sacrifice in one area. But could you share a little bit about like the process and how this got done under really unique circumstances?
Well, fortunately, real estate's all about, fortunately or unfortunately, real estate's all about location, location, location. And this was a great location project, and it took a little while for people to figure out the uniqueness of this project and that there was actually going to be true value creation. And that's how everyone got comfortable with it, including the lenders got comfortable with that high advance rate, because there was true. Well, you never know until the end of the day, until the project's finished and it's leasing up. But everyone is very confident of the true value creation that's being done in the construction project versus, there's some other projects that are in good areas, but all of a sudden, since it's a good area, the value of the land's been bid up, and they haven't owned the land for a long period of time, and all of a sudden they're facing 20% construction cost increases, where they're all of a sudden at the end of the day, it's a great potential project in a great area, but all of a sudden on a loan to cost basis, there's not. It's very slim.
Yeah.
So what's forcing the reduction in the ultimate advances on the capital stack is what's going to be the projected value of the project at the end of the day, and all of a sudden you're not creating that much value. So it's difficult to have a high advance rate on the loan to cost.
Yeah, I get that. Talk to us a little bit about just what was that process when you knew there was this SSA structure. In a lot of ways, it's almost identical to CPACE. It's assessment. It's just different improvements, to your point, not energy efficiency related, not resiliency. It's just more infrastructure. And so it has this tax position. You have a lot of the things come up that lenders say that, oh, you're priming me, this, that, and the other, even though technically it's a tax with no rights. What was that process like when it came to speaking to lenders? Did you find there was particular talking points that resonated? Maybe just share a little bit about that.
Well, there was some situation, it got into the same situation where you'd have some lenders who are like, hey, I like this project at all. I think it makes sense. And then all of a sudden when they're realizing that, it's got the SSA bond component to that, or a CPACE component to it, their leverage is being more advanced than they can, or they could for the existing time frame. A lending institution may have it within their their loan policy that they're precluded from doing these loans, even though they feel their senior lenders feel it's a good idea to do that. They're like, well, right now it's a non-starter for us. Unfortunately, I hear you. Everything that you're talking about there are good points, but right now we're not going to be able to get it through our loan committee at the end of the day. We can't get our policies changed. So it took getting through to a lender that had the policy approvals that they could do the transaction, and they saw through what was ultimately going to be the end product.
I mean, I just think that is such a need when it comes to doing these creative solutions. I mean, it's so funny that oftentimes over the years I'd gotten requests like, hey, could you send me a CPACE lender list? As if like, and there was like these lists going around that were from like one of the organizations that puts together some information. I was like, it's going to be so misleading. If you have a lender on that list that's, maybe what they did was like $100,000 CPACE for like a lighting job on like a $40 million stabilized mall. And somehow somebody's going to see that and say, oh, they did it. So now they're going to do 20 million CPACE on my $100 million ground up project. So I still find that when it comes to like a CPACE project or SSA, ground lease, you name it, there's such a need for a capital advisor expert in this area that's like going to almost create it. It's like you almost have to back into allowing it once you have the strong sponsor and you frame the business plan to then back into, look, we could probably get comfortable with the structure. We'll show you all the risk mitigants. So I think there's such a need. It's not just like, oh, talk to this lender. There's definitely something to be said about lenders that are more likely to be open to structure. So there's just some, and it's not just non-banks. I mean, there's a number of credit unions that they're able to go a little bit out of the box if maybe it's a project in their community and they're like, look, we want to help out to move this project forward. We want to see it be successful. So I do think that there's such a need and a role for what you're doing to be able to creatively structure. And I mean, that's an incredible win to be able to get that kind of leverage for their client. I mean, that reduced their equity need, dramatically and gave them such an upside. So no, I really think it's something to be able to do that.
And it has to be, lenders that you've got a relationship with, I believe, to be able to talk through the nuances, to be able to get to it. Or, you really run the risk of getting a long ways down the path and realize that it was originally a non-starter and you wasted everyone's time. And that's, we're about making, we're about making money, but I believe it's about making successful projects. If you put together successful projects and you team up successful people, you will be successful.
And it's really so needed to have the right attention, which comes from that existing relationship oftentimes. I mean, I think that people are so flooded these days with deal flow. It's almost like a filter out exercise. So if you're seeing 100 deals and, you got all this stuff to look at, you're probably going to filter more towards the folks that you have relationships with to at least give it attention and then be able to willing to hear a story. So I think that's just something you got to lean on. And with regards to anybody that's looking at something like a CPACE or an SSA bond, or frankly, I know we talk a lot about ground lease structures as well. There's probably nothing better than speaking to somebody that's actually done it. I mean, there's a lot of people that talk theoretical. They talk about what they could do. And at the end of the day, they still haven't even done anything with it, So it's like, it's really, you could get yourself in a lot of trouble when, you're seeing these advertisements about, these crazy rates and this leverage and somebody getting this done. And when you drill down into these things and you're just shocked that it's not been done yet, and so you really need to get some diligence done, find out what somebody's done recently, how much of it have they done. It's just so important. So I thought it's great to have somebody like yourself on this just to be able to, highlight some of the recent success with this type of creative structure that frankly, most people have never heard of, let alone transacted with. So anyways, so let's talk a little bit about...
CPACE is not a bus.
I know. So what's the focus these days? Let's talk a little bit about, some of the exciting things, in this regard. We're doing some really cool projects together. But what's exciting for you? What do you see on the horizon when it comes to what's happening?
A lot more, ground up construction of figuring out ways to get higher up on the capital stack and do it safely. That sounds like an oxymoron. It's safely putting on more leverage on a project, but it's figuring out how to prudently do it.
Yeah. In that regard, folks that want that, I mean, everybody wants that. What would be some insight that you could share having, that's probably one of the things that you do consistently is you really focus on executing higher leverage solutions. What's something that you could give somebody as an insight or takeaway, something to consider as a frame of reference to think of when going out to the market, whether it be a borrower that has a project? How should they be looking at it? What's possible? What's realistic?
Is spending the time on the front end to drill down into the project to make sure that you've got an assessment of your costs and what the execution is, so that you can have the lender be more comfortable about what the true costs are, and there are some belts and suspenders on the project. You've got some contingency that's built in place. You've got a little bit extra interest reserve since we're talking about construction loans, and you've got the proper people in place to execute on the strategy. Most of the time, the sponsors will be lacking in some areas, and you try to figure out ways to augment them with the proper professionals that are needed in those transactions. So you come forth with a good plan, and you go to the lender with a good plan, they will spend the extra time to look at the transaction, do that, and then that's how you build relationships. And and then they identify that you provide quality projects and you've had successful outcomes of the projects. People want to deal with successful people.
Yeah, I think that's the start. Make sure that you're filtering for the folks that have already had some great levels of success, and then you can now be able to expose them to just wider range of solutions for their projects. But I think if you could start with like the right jockey, start with the right bar that's had some really good track record and success, a lot of things could evolve very well from there. So I think that's a great way to go. Where do you think is the future of CPACE? What do you think's going to happen? What's a good fit for it now over these next 6-12 months? Any thoughts on that?
Well, I'm hearing there's a bunch of it that's going on in like in New York City, where there's some mandates for some increased energy efficiency, and I think there's going to be a fair amount of that coming around.
Yeah.
So that may necessitate, or that there may be a push based on that mandate for the regulators to loosen up their criterions on allowing CPACE with banks.
Yeah.
So lots of times the banks will take some guidance from the regulators. So if the regulators are fine with it, then they will be fine with it much quicker.
Sure. Yeah. No, it's really important to know, what are decisions being based on? And if you have certain people that are loosening up and maybe even changing certain priorities of guidelines, especially with everything happening towards these mandates of, decarbonization. It was interesting. I was at this conference a couple of days ago, and what came up is, in addition to the regulatory environment putting pressure on, more and more folks needing to focus on this, what came up is that more tenants, more businesses that are going into commercial buildings are actually having certain needs that if their building doesn't have a certain energy efficiency or decarbon strategy, they can't be part of the comp set. So you're talking about like your major tech companies that are going into pretty big spaces in major cities around the country, saying, we need to make sure that your ESG policy and your building is operating under a certain standard. Otherwise, can't go in. So I think that even without the regulatory pressure in certain cities, I still think that all the cities are going to have that need to just stay relevant. And so I do see that continuing to happen. It was a very interesting insight that came up a couple of days ago in this conference. So good stuff, man. Any, we're kind of wrapping up, but any kind of last minute takeaways, anything you want to share, any kind of things that are on your mind, things that are happening in the business, insights, takeaways?
That I think, traditionally, if you look at real estate cycles of boom and bust, is toward the end of the cycle, you start stretching the leverage on lending, and by and large, I haven't seen a stretch in the lending in the banking sector. There's starting to be some stretch, I believe, in some of the renovations of the single family houses and some of the smaller apartment complexes, but a lot of the ground up construction that's going on there is still pretty
measured. Yeah.
There's it's more conservative than what's going on. And so I believe, so that theoretically should mean that this real estate cycle's got some more legs to it.
Yeah, I get that. So I had a question asked at the beginning of the show, and I asked, what leads to best execution? And we've kind of touched on this a few times throughout this conversation. And I just feel like this is just, part of my conversation ongoingly, but it's typically best execution comes from having options. It's like, one of those things where I think what you do well, and one thing that I focus on, you shared about it, when you nicely talked about our relationship, how we, always brainstorm is, sometimes a particular tool isn't going to be the right solution for your problem, your challenge, your opportunity. And so you got to have multiple tools. And I think, CPACE, I always look at it as one of what should be a few conversations, that you want to have with the borrower around how you're going to be able to approach the market. So I think, you guys do it right. When you go to market and you're looking at how to creatively execute, you're looking at CPACE, you're looking at ground leases, you're looking at lenders that have different profiles. And I think that when you go out with options and you could run different plays and scenarios, it just leads to more possibilities. So I think for me, that was the answer that I found when it comes to best execution. have multiple approaches. So what about you? Any thoughts on
No,
that?
I agree with that, and I want to continue on it. I think, that's what my philosophy, and that's why I joined the Geneva Capital where I am, is kind of a similar philosophy, is we believe in a targeted approach. We're not, directly a rifle approach when we look at, a transaction with the sponsor. Is we're not looking to go out to 50 to 100 different lenders. We're looking to go to a select, half a dozen or less lenders, lenders that we have relationships with, so that we can actually talk through the project, and we can look to how to mold the project with the lender and with the sponsor to come up with an ideal solution. And as we're doing the molding of the project and the best execution on it, we'll have a couple of lenders that will drop off, but we're traditionally dealing with lenders that we've got relationships with, and that we know that we can execute, and we know that there won't be major changes at the end of the transaction. Beyond, there are always some little hiccups between starting and closing of a transaction, but we want to work to minimize that.
Yeah, no, I like that. I agree with that. I think you're in the inner circle, my friend. So I love working with you and Wayne and the team. And I think we're just I feel like in some ways we're just getting started. I think that there's just an amazing, exciting future ahead to
absolutely
to realize some more of these possibilities. So thanks so much. It was awesome being able to have you on. I really enjoyed being able to share a little bit more of this success, and look forward to doing this again, but I'm sure I'll be talking to you probably later today.
Yeah, we will.
So, awesome, Brent. Thanks so much.
Thanks, Adam. Appreciate it.
Talk to you guys soon. Thank you guys so much for tuning into this episode of the CPACE Confidential. Please like, comment, and make sure to subscribe on this. We're available now in Apple Podcasts and Spotify, and we hope to see you on a future episode. Thanks so much for tuning in.
Thank you for joining us on another episode of the CPACE Confidential. Give this episode a like and subscribe so you don't miss any of the fast-coming opportunities in the world of CPACE. Got a question? Message us on LinkedIn at Adam Harris Lipkin. See you next time for another edition of the CPACE Confidential.